Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Okay, just before we start, let me make sure my Mac is working. Okay, should be okay. Nothing is muted. So in this week's lecture, we're going to actually focus on one last task for your assignment. So if you can recall that the process we completed our enterprise DCF valuation model. We had a review of the model, the structure of the spreadsheet, and also we discussed the topics of reorganizing the historical financial statement of a company just for the purpose to be used in KGW model. And then we discussed about the forecasting models. These are the technical tools that we can apply in forecasting the revenue, margin, and capex, these key inputs into the KGW model. In week 5, we discussed the estimation of the parameters of WACC estimate. Then in week 6, we discussed the possibilities of incorporating growth into your forecast model. And after that, we discussed the multiple valuation and the asset-backed valuations. And these are techniques should be used as supplements to enterprise DCF valuation model. And last week, we had a discussion of scenario and sensitivity analysis. These are the methods or technical tools that you can employ to round up your overall DCF valuation model. So lastly, when we have a well-rounded enterprise DCF valuation model, now it's time for us, the analyst, to issue a recommendation. It's so-called investment recommendation in the ordinary analyst report. But today we're going to discuss some concepts. Hopefully I can put you in a better position to understand price and value. They are quite different things. They do interact with each other and maybe at the same time driven by the same fundamental drivers, but they are different things for us analysts. So the last element of your assignment will be issuing a buy, hold, or sell recommendation. So today we're going to focus on how we're going to understand this so-called investment recommendation, and I'll give you some guidelines how you might devise this such recommendation. On the workshop on Wednesday, we're going to look at some issues to write up a relevant analyst report. So still my focus will be still on giving you the chance, the exercise, to help you to understand how analysts in the industry write. So it's not like the assignment you have done in the first year and second year finance courses, like you have a group of people and write, maybe copy paste some paragraphs from somewhere, and if it's related to the topic or to the assignment tasks, then you're going to have some marks. So on Wednesday workshop, we're going to look at very specific students' assignments from the past and just have a read. Ask yourself, why do the professional investors who like to pay you thousands of dollars to read your report? So I still want to put you on the right path to become an analyst, not just a student. Hopefully at the end of the semester, you're going to have a big step transitioning from student to analyst. So that's our plan for this week. I'll try to finish the lecture in the first hour. The second hour, I'll try to discuss some particular issues to help you to do the asset-backed and multiple valuations. Sorry for my coughing. So the first concept will come into play in devising an investment, in quotation mark, recommendation is to distinguish price and value. So what's value? Up to this point, what's value? What are the factors determining the value of your company? What are driving the value of your company? I'm sure you can say some words, say something now. Can you give me some indications? What are driving the value of your company? ROIC. And what else? Growth, the growth opportunities. Can we be more specific? If we're going to find some measures, how are we going to measure growth or value? What are the measures in finance vocabulary we use to describe value? Yes, exactly. So it's still the old school net present value of the future cash flow and discount rate. So the cash flow, the future cash flow, and the discount rate are the single things in our context to consider value. Don't think about the pricing movement yet. So value is determined by the future cash flow and discount rate. And if we step further to put a company in this context, we understand there will be ROIC, and especially the spread between ROIC and the discount rate, and the other ratios we rely on in our forecasting and analysis, the margin, capital turnover. So all of these are driving value. Beneath these financial ratios are not just cold mechanical equations. What are they? What are the driving forces of these margin, turnover, and ROIC, and in turn value? Products, yes. Industry, yep. The segmentation of the industry, the products, the services they provide to customers, so human beings' decision making. So the management decides how they're going to generate shareholder value by improving the customers' satisfaction. That's the voice of customers. By generating more value for each shop, that's to improve the turnover of the overall company. So beneath these financial ratios, the numbers are the decision made by the management and the hard work of every single employee, and also the industry structure, and also, if you look at a larger picture, the general economic performance of Australia. So we are looking at value in this framework. Now, what's price? What's price? We can observe the price, the transaction price from ASX website or the company website or any data providers. What's that price? What's the price? What's the price? Why today the price, when the close price is $25? What are driving the price in the market? Maybe be more specific. These are transaction outcome, right? If some investors believe I really want to buy some shares, I go to dealer, depending on the size of your order, dealer or broker, you buy the shares or sell the shares. Financial assets, like anything else in the market, they are products or sort of commodity. So the price you see from the market is determined by supply and demand. Right? So if the supply order exceeds the demand, the buy order, you're going to see downward pressure on the price of Woolworths share. So the price is explicitly determined by the supply and demand and their relative strength to each other. What are driving the supply and demand? That's what you have mentioned, expectations. What else? Yes, that is supply. Yep, there will be more shares outstanding in the market. That's the supply. What are driving the supply and demand of Woolworths shares? Investors, their own take of if this company is a good piece of investment. How do they make this judgment?
Also based on
Analyst forecast? Okay, so for sophisticated investors, they run a DCF valuation model, like what you have done in this course. So now we see that price determined by supply and demand. The supply and demand will be driven by expectations, underlying analysis of the company's future cash flows, discount rate, so value, that's the value. And what else? Consider the recent experience of Tesla. Did you read the article I posted on Water? Okay, that's very fascinating development of the company. So over a day, the share price just had that huge drop, simply because Elon Musk was investigated by SEC, and his influence over the company's future is going to be limited by the different areas of the sort of activities can be involved in the company. Is that share price change driven by something related to value? Liquidity, and is it driven by value, underlying drivers of value? Think about, okay, his involvement in the company is going to be limited to this level. What are the investors worried about when they started selling the shares, obviously? Yes. He's going to be for certain discretion over the company's everyday operation, because he's the CEO and the chairman as well, and he got very much direction on how the company is managed and how the decision is made. And if you observe his behavior, especially on the social media, and he was such a controversial personality, and the SEC investigation actually targeted his, the announcement, sort of, although it's through social media that kind of taking the company private, but it was considered as misleading information for shareholders. So the regulator was trying to, okay, this is your responsibility as the leader of the company. You cannot say whatever you want as this figure. So going forward, it's like they're giving him a warning. Look, you have to consider your social responsibility and consider your responsibility of the shareholders. So, and there's also, they have a private settlement behind the doors of maybe he promised to do certain things or promised not to do certain things. And also, I think going forward, the investors are particularly worried about the strength of Tesla in competition against other major automakers, because he's such an adventurous person, and much of the current stock price incorporates this kind of potential, huge potential, directed by this single person. So if you're going to run a valuation model of Tesla, it looks like right now the person, Elon Musk, is a risk factor. And it might be an important factor influencing the cash flow and the discount rate, maybe as well. So if you see the huge change of stock price, that might be reflecting a reversal of investors' sentiment if you hold the view that the company has been overvalued. That was like this kind of investors' exuberance towards this industry or the company. Or it might reflect the value loss of the possibility in the future that he's not going to be a long-term leader of the company. So up to this point, we had the discussion of price and value. So over long term, price should follow the intrinsic value on average. That's what we have observed from our experience in the equity market. There's some extended period of price diverging from value. Think about the around the years of 2000, before the technical bubble busted. So some of the most elite analysts were issuing strong buy recommendations on a lot of technology stocks based on close to 100 times of PE ratios. Right now, if we have this kind of PE ratio of any technology company, we will doubt, okay, this doesn't look right, 100 times of PE ratio, given currently the current PE ratio of the market is close to 20 times. The long-term average is about 16 times. So given our experience of the technical bubble bust, we might be questionable of 100 times of PE, and we're going to doubt over that strong buy or buy recommendation from the analyst. But at that time, back to around 2000, investors were so passionate investing in the technology companies, and capital just flow into especially NASDAQ and some of these technology companies with a lot of expectations. That's something that we like in the equity market. How much of this increase of share was driven by the fundamental drivers, future cash flow and the discount rate, or in particular the margin, the turnover, and these financial ratios we can read from the company's performance. That investor exuberance lasted for a few years until something triggered that sell-off, and suddenly all of investors, no matter they are individual investors or institutional investors who are supposed to have better information, better resources to analyze these companies, they suddenly realize, okay, 100 times of PE ratio was not reasonable. There must be something wrong with this sector. So that's what we observed, a huge sell-off of the technology companies. So the price can diverge from value for an extended period of time. There might we need a catalyst, an event, something that will trigger the correction of the divergence of price from value. But over long term, price should follow value. Just it's uncertain how that correction will, how long that time that correction will take. So for our assignment, our focus is on the value, the fundamental drivers of the company, the cash flow, what determines the cash flow, what determines the discount rate. That's our gauge of value. So what about the price? Right now in the market of consumer staples and Woolworths, is there any excess demand from investors? is there any really high investor sentiment in the market? Like they really like consumer staples, they really like Woolies stocks? It's not very likely. Its current price is about a little bit over 20 times, and price to book value ratio is about 3.5 times. So it's a little bit over the market average. How can we understand this premium? Does the company deserve a premium? Or maybe the premium is driven by investor sentiment or this sudden increase of demand? Can you say anything? So far, you have done a lot of research on the company, on the industry. Okay. Woolies' PE ratio, based on 1 year forward earnings, is about 20 times. It's a little bit higher than the market. And its price to book value ratio is 3.5 times, still a little bit higher than the market. Does that premium represent a true premium driven by the fundamental drivers or investor sentiment? No? Anything? Okay, let's talk about the fundamental drivers. You have done a lot of research of the industry and the macroeconomic drivers. Are they sound enough to support this kind of premium or the current pricing of Woolies? Just say your opinion. No? So what's your opinion of the pricing? You believe it's overpriced? Or maybe it doesn't deserve this premium? It should be priced similar to the market average? So you believe currently in the market there's investor sentiment that's driving the premium, the PE ratio and price to book value ratio? So why? Why? I'd like to know why. Why do you believe so?
Fundamental means it affects everything in the industry. All of this above the average, then by definition, everyone else must not be as high as Woolworths, but it's the same industry, so they get about the same fundamental growth areas.
So you did mention that it's doing better than the other key players like Coles and Aldi, especially. So you do believe it's better? It's better than the comparable funds or the industry average? Does it deserve this amount of premium? So what's your belief of its proper valuation?
As in, like, its value is too high or too low?
So now it's priced at a premium over the market average. So what's your belief of this premium? Market average, the general market. Above average, because of the nature of the business, and its investors should be less sensitive to. It's not growth stock. What's growth stock? There's growth potentials, or if you run enterprise DCF valuation model, you will see much of the value will be driven by the growth aspect, revenue growth, margin, or the continuing value, so something not really in the next 2 years or 3 years in the future, or a large spread between ROIC and WACC. So this company has access to these kind of real growth opportunities, not really just a positive revenue growth. So obviously, Woolworths is not this kind of growth company. It does have its competitive advantages relative to other players in the market. That's this relative competitive advantage and the nature of its business warrant a premium. Low margin. Yeah, that's right. It's low margin. Can you recall that last week I presented colorful graphs of the price to book value ratios of several major industries? We observe an obvious upward trend of the price to book value ratio of all of the industries in that graph. What's driving that? After 2011, the steady, robust economic recovery from the global financial crisis. So, in other words, the general market has been performing really well in the past several years. That's why you see that upward trend of price to book value ratio. And given the Woolworths' competitive advantage, now consider the Porter analysis you have done, its strength in that particular industry. I believe it does deserve a premium. Maybe currently the size of the premium is okay, not really driven by too much investors chasing of returns or chasing of high-risk companies. So what we have gained from our valuation, on top of that final per share value, and what we obtain from this whole valuation process is actually our understanding of the company's corporate strategies, the competitive advantages against the other key players in the industry, and how the industry is evolving in the next several years, and overall how it's going to be driven by the macroeconomic developments in Australia. For example, population growth, disposable income, real wages growth, and in unemployment rate as well. So all of these are part of the fundamental drivers to drive the customers will walk into shops to put this certain amount of items into their basket. So that's the purpose of doing this whole valuation exercise. And you probably have found out, no matter the share price you generate from your valuation model is 25, 28 or 30, 35, you do have the freedom to incorporate your own judgment into the valuation process. It doesn't mean that if your price, your valuation is different from the current price, it's a wrong valuation. It doesn't mean that it's a wrong valuation. It's possible that you see something that the market doesn't see, or it incorporates something that the market fails to incorporate in the current price. When we look at the multiples, that's where we're going to round up our enterprise DCF valuation model. We look at the relative premium and discount of the company to relative premium discount to the market and to the industry average to its closest comparable companies. We try to understand if this valuation is driven by sound premium or competitive advantage of the company, no matter its price to book value ratio or its price to earnings ratio. Price adjustment does need a catalyst. The market needs some time to digest, to incorporate this new information or the underlying changes of the company into the buy and supply of the shares of the company. So that's relative return. On the left, we have the relative return, the red line here, of borrow relative to the ASX 200 over this takeoff period for building material companies. And the black line indicates the 1 year forward earnings per share of the company. So given the large scale of capex into that industry, there was excess capacity and they were very much competing with each other on pricing. So not really on efficiency. So that given the excess capacity and very small, very weak pricing power of this building material company, the return, the company performance struggled a lot before the 2000. And at the end of 1990s, there were several merger acquisitions within building materials. The excess capacity was squeezed out of the market, and they started to compete with each other on the front of operational efficiencies. So cutting cost, shifting the products portfolio, following the investors' demand, following the customers' preferences. There was a steady increase of EPS of Boral and other building materials companies as well in the early part of 2000. And that coincides with a healthy market boom in Australia. That's very strong performance relative to the market index. That was 2.5 times of relative performance. If you look at the P/E ratio during the same time, before this takeoff, the P/E ratio of Boral was about 8-9 times of their earnings, 1 year forward earnings. When markets started to realize, okay, there are some real changes in the industry. So the fundamental improving of Boral, and you will see the P/E ratio of Boral was pushed up to about 13 times. And at the same time, between 2001 and 2003, you will see the steady increase of their earnings and relative performance of the return. You see the P/E ratio dropped a little bit. Okay, there was like market started to realize, okay, there are some real changes with building materials, let's buy building material companies. And that's the reason why it was pushed up to 13 times. And then afterwards, some investors realized, okay, this is maybe too expensive for building material company. And that dropped to around 10 times again. At the same time, with that P/E ratio of around 9 times, or 9 to 10 times, at the same time, that's between 2005 to 2015, we still see the earnings, very strong earnings performance of the company. But the relative pricing, the P/E ratio, was still depressed. You see, during the 2004 and 5, the EPS of Boral was at the top, at the peak. That's the real dollar earnings the company has generated. But it was not rewarded by investors in the market if you use P/E ratio as a proxy. It's only until 2005 that the market realized, okay, the real changes within the building material is for real, and they are fundamentally better companies for investment. And at the same time, you see a little drop of the EPS, but it's still at very much higher level than when they have started at the early of 2000. So almost 2 times of EPS, and they were rewarded by a premium of pricing. That took about 5 years for the market to realize, okay, these changes in building material companies were for real, and they are operating as a better company. There's much efficiency gains in the industry, and with borrow as well, and they are rewarded with a PE ratio increase. So the point is that okay, the fundamental changes might be gradual, and you will see the operational changes executed by the management over a few months, over a financial year. Sometimes it takes a few years for the market to realize the value gains and incorporate this in pricing. The drivers of price. There's a very long list of drivers of price. The earnings, obviously, the first one, the momentum of earnings, and also the growth potential for new investment. If the growth opportunities are for real, we're going to see higher cash flow and higher valuation. Price should follow this increase of value. With the macroeconomic cycles, these tend to be tricky for a lot of companies. You probably have realized from your own forecasting models, if you simply use real GDP growth rate as proxy of the real revenue growth rate for your company, you're going to ignore a lot of the company corporate decisions, strategies, and also the industry structure in your forecast model. And themes that will determine what particular group of companies or industries are in favor. They are going to be chased by investor capital, investment flows, and they're even driven by themes, the relative strength of 2 countries or relative strength of between 2 industries. Reaction to news flow. So every day, every second, we always have this continuous information flow of the company. We got to decide if this piece of information affects valuation or not. You will see price may be driven by the information flow, but value is only driven by the information flow, new information related to the cash flow or discount rate. These are the key aspects we look at if this information matters for the valuation. So we're going to discuss these factors that are driving price, just very generally. The earnings. So almost every quarter, the company needs to issue an update of their trading, their operation, and provide a guidance of their earnings. Especially analysts and investors will be looking at the half-year earnings forecast and also the final, especially the last quarter of the financial year, to get the better information of the earnings for this financial year. And also at the same time, management will be providing update of their future earnings, their new capex, the new corporate strategies in place, which are supposed to be related to value. So what market has incorporated is their forecast of the earnings of the company of the underlying, the fundamental models. So the things that will change the price or value will actually be surprises. what's not already incorporated by the market. So if the new earnings update is out of surprise, and you will see a significant share price movement. So the investors are trying to incorporate this new piece of information because it's related to value. The company is permanently or fundamentally better generating future cash flow. And this earnings revision can last for an extended period of time, for a few quarters, even 1 or 2 financial years. That's the performance of Coca-Cola Amatil. For that, that's really an earnings. The shaded area indicates a downgrade cycle. So the company issued earnings update to investors, to the market, of their latest development of their trading, selling the soft drinks. And that coincides with the market take of their future earnings abilities. So this share price drop over that earnings downgrade coincides with this real information of the fundamental drivers related to value. There are several earnings downgrade, and you will see the share price have reacted to this, the fundamental changes of the company. Later on, we'll discuss what happened to Coca-Cola of the underlying operations. So if you just have been listening to the radios, you should know that we're going to have very hot summer. If now is the first time we hear about the the weather forecast, we're going to have a very hot summer in Australia, all states. Now you are the analyst who's following Coca-Cola, and you run a KGW model of all of the forecasts of revenue, discount rate, on all of the margin and stuff. Now I'm going to ask you, are you going to change your valuation? Are you going to change some forecast of your valuation given the latest weather forecast? Why? Okay, so we do have a weather forecast of this summer, very hot summer. Consider your valuation model. That value is net present value of all the future cash flows. In valuation, we take a very long-term view of the company. We forecast explicitly the revenue of the next 5 years, then 10 years, and the continuing value. We have a weather forecast of very hot summer this year. Does it warrant a valuation revision? Yes, that's one side of the problem. And by how much? Does it really change the valuation of the company? Is there any fundamental things changing with the company that the company is positioned to generate higher cash flow than what you have forecasted in your model? Or is the company positioned, or the market warrants a decrease of discount rate? I would like you to go back to have a look at your model in the valuation summary of the economic profits and the free cash flow tables. How the percentage of the next 12-month revenue, the free cash flow, will contribute to your overall valuation. Have a look at the number. It's true that it's next 12 months. Maybe it's relative to other years, it's got a higher weight. But what you have here, it's a very long-term forecast of the company, driven by its corporate strategies, its industry competition structure and the population growth and the investors' preference, all of these changes. A slightly increase of the next 12 months, or not already 12 month revenue change will have a very small impact on your valuation. So when we think about does this matter for valuation, we ask, okay, given that long-term time frame, does this news information carry something related to the changes of free cash flow and the discount rate? So to understand this impact, you might just run this test with your own valuation model. Change the revenue of Woolworths for the next 12 months by a certain degree and see how the value will change. So a weather forecast of a very hot summer for the next 3 months, it might change the valuation, but the changes will be very minimal because there's nothing new about how the company is running its business, or there's nothing new about the industry structure that the company is operating. Now, if I frame the question like this, there's climate change, and it's been controversial, debate at the Parliament, as well for industry, for a lot of people. If now we are very confident that this climate change, and Australia, because of the geographic uniqueness, we're going to be in a very long-term cycle of El Nino change. There's climate change, and we're going to forecast that for the future, we're going to consistently having higher temperature than the historical average. Does this warrant a value revision? Are you going to go to change your valuation model? This is much stronger reason for you to have re-examine your valuation. So if we're going to have hotter weather, and there will be more demand from customers of cold drinks and soft drinks, if the customer's preference does not change significantly, this will warrant a much stronger demand of the products from Coca-Cola. So depending on that piece of information, if it's related to the fundamental drivers, we have to decide if it's going to change the valuation of the company or not. The next driving force of stock price is the growth stories. So we have talked about the true growth opportunities in week 7. Here I'd like to talk about these the cycles of the growth, especially with JB Hi-Fi. It's an Australian company, and it's retail. It's much easier for us intuitively to understand this growth. So after early 2000, JB Hi-Fi had a very good ride of rolling new stores, and because driven by the increase of disposable income and the cash generated by the resource sector was actually pumped into consumers' pockets. So there was very strong demand of consumers of personal electronic products and other personal computers and these products. And there was very limited investment before the takeoff, the high demand of customer of electronic products. So JB Hi-Fi successfully identified these growth opportunities. They started their store rollout plan very aggressively. They are still occupying the best spots in a lot of shopping centers, and all of the new shops will actually greeted with very strong demand from customers. That's the high growth. But up to a point, they found out up to this point, when I open up a new store, there will be less strong consumer demand because the demand of personal electronic products became saturated. We only need a computer maybe every few years. We need a smartphone like every few years. We don't buy it every day. So when the market became saturated, JB Hi-Fi still roll out their new shops and they were in big trouble. I would suggest you have a look at the performance, financial data, stock returns, and price of JB Hi-Fi from 2000 and afterwards. You will find these changes. They did have a very good growth period because they met the strong consumer demand and roll out new stores, and they could generate very strong revenue for each of these new stores. But up to the point when the market became saturated, they were not able to generate any value by opening up new stores. Similar problem existed with other retailers like Harvey Norman as well. The capex. So investors really like capex because that's how you're going to have future cash flow. It's not news now when there's a potential capex or the capex commitment with resource companies, with pharmaceutical companies, this investment of the company's future ability of generating cash flow, you will see investors really like this news. So with the new capex investment, they are often accompanied with share appreciation. That's the investors would like to capitalize on the future opportunities. This graph shows the relative return of Crown, that's a casino company, relative to the market index. For that good run-up, they were operating on actually temporary gambling premises. So they were like temporary tents, really, in that period. I didn't see it. I just knew this from my colleagues, older generation colleagues. In the 1890s, they operated in temporary tents. Very minimal of capex, but very strong cash flow. See that relative return to the market, very strong. And then they decided at the second half of 1990s, we're going to build a permanent casino. That's a huge amount of capex. So that point was when the permanent casino opened in May 1997. So capex, the capital investment, the buildings, all of the purchase of the equipment have been done. And if you think about the financial statements, especially the P&L, they have large scale of capex. The revenue, free cash flow, hasn't catched up yet. So that's a depressed return on equity and ROIC as well. At the same time, investor became worried that, okay, with this huge amount of capex, can you generate the forecasted cash flow? That's when the price was depressed in 1998, when the market was worried about the future ability of generating cash flow. And that's when Kerry Packer bought the casino, the physical permanent casino, at very cheap price. When capex was done and the performance was depressed, return on equity and ROIC, and also the market was nervous about its future prospect. But Karataka decided, okay, this is a good opportunity to invest, and he purchased this Crown Casino at a very cheap price. And later on, we understand what happened in the second half of 1990s and also the takeoff of 2000. That's a huge expansion of the gambling industry, the licensing changes, and also Australian people had more money in their pocket for gambling. That's still generated from the mining sector. So when the capex is in discussion, it's expected, investors usually respond to this prospective capex with very much passion. When the capex is done, they will be worried that, okay, this money has been spent, are you able to generate this cash flow? So with any capex announced by companies, you got to ask yourself, is this going to be improving the cash flow generation ability of the company in the future? The acquisitions, we had some discussion of the merger acquisitions in week 6. Also from empirical evidence, we understand, on average, most of the value increase, no matter it's generated from the synergies or whatever the sources, these value gains will be more likely to be accrued, received by the target shareholders. The most important reason is actually the acquirers tend to overpay the merger acquisition, especially when there are other bidders in the merger acquisition. So whenever you read any news of merger acquisitions, you have to examine the experience of the potential acquirer and see if you can pinpoint where they might generate synergies. Or if they just say strategic, be very careful. That means the management has difficulty to pinpoint where they're going to generate synergies or value gains for the acquirer shareholders. If there are other bidders, it's going to be very likely several times higher that the acquirer is going to overpay for that merger acquisition. QBE example, that's what we have discussed in previous lectures. The macroeconomic cycle. So that's probably a lot of groups have made mistake or misunderstood the macroeconomic drivers in your forecasting model. So here I give you an example like, okay, if I really like the growth story in China or other emerging Asian countries, I'm going to buy all of the mineral stocks because I believe they're going to buy more minerals. There will be still strong demand of the Australian minerals and other resources. Is that too simple? That, okay, do you understand the underlying drivers of the economic development in China and all the other emerging countries? What are driving the demand from China and other emerging countries of Australian resources? What are driving this strong demand? Do you have any ideas? Why? Why do you think China and some other emerging countries, they buy a lot of resources? Iron ore, coal, construction, manufacturing, so infrastructure investment, and partially demand from the manufacturing. What's the economic development policy in China? So obviously, for the past, actually starting from the year I became an analyst, Chinese government was talking about shifting the economic structure from infrastructure driven to consumption-driven model. That's their ideas of developing the country's economy in place for like 2 decades already. But how much of this policy has been implemented? Is Chinese economy still driven by infrastructure or consumption? Not really. Need to have a look at the data. Infrastructure investment directed by the government. That's where the largest demand of the Australian resources. The consumption does have a strong growth in the past 1 or 2 decades, but is still not taking over the growth in the infrastructure investment yet. So this economy is still very much driven by the investment in infrastructure, not by consumer consumptions or the development of service industries. So if you have a very simple opinion of the demand from China of Australian resources, you got to buy all of the resources stocks, you're probably not capitalizing on the fundamental drivers of this prospective growth. What about the urbanization of Chinese people? And what about the industrialization of its traditional industries? So there has been some shift in the in terms of demand from simply resources, the metals and the fuels, to other commodities, agricultural commodities, coffee beans, sugar. All of these are driven by the rise of the middle class consumptions in China. Simply buying resources is not a well-based investment decision or our very well-based analysis of the demand. Another example is at the start of Australian resource boom of early 2000s, that's all of the emerging countries were recovering very well from the Asian financial crisis, and the economic outlook of emerging countries and world economy was quite good after the technical bubbles as well. So there was a steady economic recovery around the world. So at this point of time, 2003 and 4, investors believe, okay, there's such stronger demand of commodities. But commodities, they are different. For one commodity, for instance, the minerals, and they were lack of large-scale investment for quite extended period of time, and this exploration investment takes a long time to realize, and also the revenue to generate it from this industry is going not like you're going to see the revenue in 2 years of time. But with other commodities like paper industry and also other industry commodity as well, the entry of this market is much easier, and you're going to see the establishment of new factories in a few months or in over 1 or 2 financial years. So with still the minerals and paper, they are still commodities. There was capital inflow into both segments of the commodity market. There was such lack of investment in the resource industry for quite a long time, and that coincides with very strong demand from China and the emerging Asian countries. And that's why you see the relative return of the mining stocks. They had a stellar performance over that huge run of resource boom. That's especially if you go to have a look at the relative returns of Australian resource companies, they follow a similar path over that 10-year period. But with paper stocks, this much easier investment, and it takes just a few years to establish the forestry as the raw material in the paper manufacturing. And there was over-investment as well, because the investment was much easier than building the railroads, exploration of the resources. There was overcapacity in that segment for that commodity. And you see that's the relative return of paper stocks relative to the world index. So the same commodity they belong to commodity market, but the performance can be very much driven by the industry structure of their individual segments of the market. The themes are driving investors' perception of the growth period, of the growth segments of the equity market. So that's a list of what happened, what investors have been chasing in the past several decades. So you'll see all kinds of themes came into this list: Asian growth, emerging markets, crisis, China, resources, demand of resources, de-risk. There was 2 periods of de-risking: the global financial crisis and also the 2011 and 12, when investors around the world became very worried about the impact from the large-scale quantitative easing of all of the major economies on the future growth of the world economy. And also, in the past several years, we had a very nice recovery of all of the major economies around the world, and you will see the different themes. In the industry, this is very much driving what analysts will discuss in their report to investors. It takes a lot of courage to be different. So you do not really have the freedom to write whatever you want in your strategies or report to investors when you do become an analyst. And of course, for your valuation report, you do not have the freedom to issue the buy, hold, and sell recommendation as you like. From the academics empirical analysis, analysts around the world, even on Wall Street, they tend to issue less downgrading and less sell recommendations for any average industry. There are a lot of considerations and possible theories. And investment flows might be driven by investor sentiments, might be driven by the themes, or actually in the past 50 years, we have observed an investment flow from the active management funds to passive index funds. This has been changing the market on a fundamental and deep, profound way. Academics and practitioners are still trying to figure out what this impact will be. At least I'll tell you that even on the floor of New York Stock Exchange, over the day, the traders, these people who are trying to help the investors to fill their buy or sell orders, they are tend to be quite relaxed over the day. Compared with 10 years ago, they have much less orders, less volume over the day, but all of the orders will come in the last 15 minutes before the market closes. Why? These large orders are usually sometimes it has to go through several dealers or brokers to be executed because of the sheer size from the institutional investors, especially the passive index funds managers. Simply because, they wait until the end of the trading day to see the capitalization, the percentage of each stock within the index, and then they go to issue buy and sell orders so that their portfolio will track the index. And this has changed the pricing of stocks in a very profound way. We understand that we need to have the tradings from investors to facilitate price discovery and information dissemination within the market. Now it's actually a real question for us now. Does the trading transactions carry information about the pricing anymore, or just simply because the capitalization of that single stock changes within the index, and you will see these large orders at the end of the trading day. And the investment flow can move the stock price, especially from the institutional investors. They have very much, because of the sheer size of their management, they can change the market price. That's what happened to Coca-Cola. So during the early half of 1990s, before the Asian financial crisis, there was a huge capital flow into these Southeast Asian countries, and there was very good performance, GDP growth, and stock market performance of these countries. Actually, the growth of these countries were financed with US dollar denominated short-term debt from the developed countries. That was a time bomb for these countries. And before that, there was very much stellar performance of any stocks related to the Southeast Asian countries. And at that time, Coca-Cola was considered as a growth stock because it built new factories in these emerging countries. They were considered to have access to lower input cost, lower raw materials, water, labor, and also they had access to an ex-growing market consumer demand in these Asian countries. So over that time, you see the relative return of Coca-Cola. They were considered as a growth stock. And a lot of institutional investors became very fond of this Coca-Cola. That drove further the stock run of Coca-Cola. And we know what happened in 1997 to 1998 when the Asian financial crisis became like a crisis, like even triggered recession in these countries, debt crisis, currency depreciation and revaluation of these countries. The institutional investors suddenly realized, okay, Coca-Cola is not a growth stock. We had too much of it. And just because of the not coordinated, but the sell-off from institutional investors almost at the same time, that put a huge pressure on the price of Coca-Cola over the time. And afterwards, that's really very much the market pricing of Coca-Cola. If you look at the PE ratio, it's very similar to market average of 16, 17, 18 times. So the institutional position can have a significant impact on the price or relative return of a stock. News flow. So when there's a new piece of information, like we're going to have a very hot summer, we got to ask ourselves, does this new information change our forecast of future cash flow or discount rate? Is there any material change? That will answer our question whether this is related to value or not. Okay, so now we have a discussion of what will drive price. And now what about our recommendation? If you are doing 3008 or if you have done portfolio construction, you should understand that before making any investment decision, what's the first step, very first step of your process to make any investment decisions? Yes, excellent. We try to understand the investment objective, investment horizon, and other circumstances. Then we make investment recommendations. Now consider our valuation report. Are we doing something like this? Are we recommending investors to buy this stock? Are we really recommending investors to buy this stock? Do we know any particular investment horizons, objectives, or other circumstances of investors? No, we know nothing about the investors' circumstances. So what's the use of this recommendation? It shows potential. Okay. We are trying to deliver actually our opinion of the company's prospect, its quality of growth, the potential of growth, and the factors that are driving the valuation of the company in the report. We are not trying to recommend investors to buy this stock or sell this stock. So the buy, sell, or hold recommendation is not for trading. They are indicators of the quality of the free cash flow, the quality of the growth potential of the company, or it's a composite analysis of the company's value. We have no ideas of any investor's objective or investment horizon at all. And what's the horizon of your valuation model? Is it short term, medium term, 3 to 5 years, or long term, up to 10 years, or very long term? What's the horizon of your investment valuation model? Short term, medium, or long term? At least the medium term, yes, because we have explicit forecasts for 5 years, and then we have these key variable forecasts for the next 10 years. So your investment horizon in your valuation model is at least a medium to long term. Keep this in mind, is that it does not indicate as any recommendation to sell or buy the stock upfront. So we are giving the investors recommendations. Okay, this is a company that deserves a buy from us, given you have a medium to long-term investment horizon. And if you have a buy recommendation, we do believe the quality of growth, the growth opportunities, and how the company is managed, and the industry structure does give us this opinion of buy. So make sure you understand you hold a medium to long-term view of the company in writing up your investment recommendation. And if you would like to do something extra, you can provide a conditional recommendation for short-term investment. Like for the next 12 months, you believe there will be this kind of development with the company, and you believe the company is at this level of there will be this new development, possible development of event will put some pressure on the price, and you recommend a hold or sell. So it's at least for your recommendation, you take a medium to long-term view. If you would like to, you can issue a recommendation conditional on the next 12-month development of the company. So this is optional. Your recommendation should be based on medium or long-term valuation. And also in your recommendation, if this is such a company or industry which is experiencing these significant changes or uncertainties, you may devise several scenarios. So depending on your forecast model, you can decide if this is an appropriate approach for you to generate investment recommendation. So next week and week 12, we're going to discuss several special topics on valuation, particular drivers like capital structure, the management, and also in week 12, we're going to have a brief discussion of the valuation of like financial firms. They are quite different from the manufacturing or cyclical firms, industrial firms that we can simply apply the KGW model. Next, I'd like to talk about, maybe not this one. This example of how you might apply the price to book value ratio valuation for your company. Understanding the book value of equity is very important, that in the sense that you got to compare apple to an apple. This should be covered in the workshop of week 8. I just need to shuffle this contents a little bit. So we have discussed in lecture that how we come up with this book value of equity. It's actually the difference of the book value of assets with the debt outstanding. So we have good information of the total debt outstanding, but we need to, so the book value of equity is going to be determined by the book value of asset. So now consider the balance sheet of Woolworths. The total assets, the total value, the balance of assets can fall into two categories. The PPE, the physical assets, and another category will be the goodwill and other intangible assets. The book value of PPE is determined by the acquisition price minus the accumulated depreciation. Okay, so we do have the framework to estimate the book value of PPE. What about the intangible assets and goodwill? They are an important part of the total book value of assets of Woolies. And if you look at other companies in consumer staples, they also have intangible assets as well and goodwill as well, especially with Wesfarmers. So to determine the appropriate book value of goodwill and other intangible assets will actually decide this book value of equity. Make sure when you do run this price to book value multiple analysis, you have a consistent measure of book value to equity across your firms. So the Y, the value, the intangible assets, and also the book value of goodwill is determined by the initial book value and also determined by the over the years the impairment. So do these companies have similar policy in terms of recognizing goodwill impairment and amortization of their intangible assets? Do all of these companies have large-scale goodwill or intangible assets? How much of that book value of equity is subject to particular accounting rules, the management manipulation, or other factors? Make sure you are comparing apple to an apple. That's my reminder to apply this method. Just simply run this analysis is very straightforward, but I want to make sure you understand what you are doing, just to estimate an appropriate price to book value ratio. On water, you also have this workshop for your multiple and asset-based valuation instructions as well. So I give you quite detailed what's required. You need to run at least 2 additional analysis methods, no matter they are from multiple or asset-based valuations. Only choose the appropriate multiple or asset-based valuations. Using the data, it's very important that you try to plot the PE ratio based on forward-looking earnings and price-to-book value ratios of your company and comparable firms. Try to look at these changes. Do you understand the changes and why, for example, Woolies is priced premium relative to Metcash? Why there's a premium or discount of your company relative to its comparable firms? Can you understand these differences? This will form part of your judgment of deciding an appropriate ratio for your company. With the normalized EPS, we have the historical data. The normalization on historical data is an exercise for you to actually apply the concept of normalization. You have to understand these candidates for normalization. Is this relevant for this company on your historical data? So for your PE ratio, if you do want to run PE ratio analysis, you need normalized earnings per share for 2019, for next financial year. So if you have a reported earnings from your KGW model, you start from there. Normalize your forecasted earnings with these from the example of lecture 8. You have a list of things that you might consider to normalize the reported earnings. After normalization, and you can use that normalized earnings to multiply with the forecasted PE ratio to get the valuation of the company. If you do run enterprise value multiples, I will ask you to do this analysis on at least 2 comparable firms. Actually, given the smaller size of the market and very small selection of comparable firms, 2 will be good enough for you to get some understanding of the enterprise value multiple, especially Wesfarmers and Metcash. Choose the relevant comparable firms and choose the appropriate multiple in your valuation. Are you going to use enterprise to EBIT, enterprise to EBITDA, enterprise to EBITDA, or enterprise to NOPLAT? All of these are going to be decided by your team, which multiple you're going to use in your valuation. And finally, you are expected to generate a composite valuation, something like this. So this will be continuing our discussion from last week, that your valuation output is only 1 point estimate from millions of possibilities. So with a composite valuation together with scenario analysis, you're going to give much richer information to your investors about the risk of the company and the underlying drivers of value of the company. That's how you're going to support your investment recommendation. Anything you want to ask or clarify so far? And lastly, I'm going to make quiz 4 available on Friday this week. It's going to be open for a week. So I want you to do the quiz after the tutorial discussion. So it's better that you have a good understanding of what's involved in the multiple analysis. Then you go to do the quiz as a self-check. It's sort of a feedback on your study on this section of materials. Although it's offered online, no one will be supervising is going to be included in the overall course grade as stated by the course statement. And some students have been asking about the final exam. At this stage, it's reasonable that you should consider about preparing for the final exam. The sample exam questions have already been on Wattle since week 1, since the Wattle site became online. So you can have a look at the possible, this kind of format of problems you are going to solve in the final exam. And you probably have found out, okay, there's no way that you can have the full picture of the concepts by just looking at the lecture slides. This course and portfolio construction, they are different from your first 2 years finance courses that you learned about the theories, you learned about the formulas, but this course and portfolio construction, we focus on the application, and we try to understand the problems of applying the finance theories, the formulas, and these are the tools or concepts or guidelines. I try to help you to solve these problems and apply these finance theories in practice. So by just looking at the lecture slides, they're not going to give you the big picture. You may use the lecture slides as an outline, a guide, in terms of what concepts we have discussed for that topic. For instance, estimation of WACC parameters. And then for any particular details, you need to use the textbook as a reference. For the final exam, the lecture slides still provide you an outline of the key concepts that will be examinable in the final exam. The final exam is divided into calculation part and the concepts parts. Only the high-level concepts are going to be examinable, not any fine details. For instance, I'm not going to ask you to give me any Excel formulas of doing any calculation. I'm not going to ask you to write a formula to calculate the price of, for instance, an acquiring shares, not something like that. But a good example of high-level concepts will be something like this. Given this company and industry and these circumstances of its financial statement, I will ask you which enterprise value multiple is more appropriate or most appropriate in valuation of the company. So you have the choices of enterprise value over NOPLAT, EBIT, EBITDA, EBITDA, and you need to understand which ratio is more appropriate. This is what I mean, high-level concepts. So they involve your understanding of the overall process or the how you might apply the enterprise value multiple analysis, and also the concepts behind the choice of different ratios. Or I may give you a list of accounting items. I will ask you which items will be most likely or not likely to be adjusted in normalized earnings. These are high-level concepts. When you finish this course, you should be able to be in a position to talk about this on this level. So hopefully, if you do go into any job interview as an analyst, you're going to have a much better information, hopefully, than graduates from other universities. But not very much about all of the examples in the textbook or very particular analysis. For instance, the tax, nothing will be asked about the tax, nothing will be asked on like the dilution, how you're going to calculate the dilution. It's very much subject to every particular company, and we often use the management forecast. So that's, we're going to have a better discussion in week 12 of the final exam. Going forward, so far, you should have started working on the multiple and asset-based analysis. Make sure you have a read of the final pages of the assignment guideline. Have a look at the marking criteria. I was looking at the evidence to show that you understand what you are doing instead of just plugging in historical average as P ratio enterprise value multiple in your valuation. Anything else you want to ask? Anything? 15 minutes. You're going to be given 15 minutes, just like any quiz in class. But this time you have access to textbooks and notes or anything, and multiple choice questions. Anything else? Okay, thank you very much for today. I think that's it for this lecture.
Question. I'm in group 11 and you were asking us if we could take one extra group member. So I'm in group 11 for the assignment. And you were asking one other person in the group if they were happy to take another group member because that person's group has all dropped a course.
You're talking about Wayne?
Yes, that his name?
Yeah.
Do you have his UID so we can start emailing him and add him to the group chat and everything?
Actually, so that has been agreed within your group that you are happy to.
We're happy to take him, yeah.
I just need confirmation from each member.
We all need to say it individually?
Yes,
Oh, okay.
because I need to have a confirmation of each member's consent. That's genuinely from the member, that's from your ANU email address.
Manoli's the only one who's done it, right? I think Manoli was the only one who said she was happy to take that member. I'll tell the others too.
Yes, I have told Wayne to ask other members of the group to send me an email into
One
it.
issue then, Shunak is also in our group, but Shunak hasn't been on the group chat and we can't reach him, so he'll never come back to you and say that he's happy for Wayne to join our group. So is it okay if just the other members let you know?
Is that person working on the assignment?
So, yeah. So, there's two other guys and Manoli, so I'll just let them know that's it. We'll just mention that Shunak isn't doing anything. Is that fair?
Are you happy with that, or you want to do something about it?
Shunak?
That's the case with other groups, that they have 4 groups that they have non-responding member, non-contributing members, and they are not happy to give him that credit. I agree with that.
I'll have a chat with the group. I'll just ask
Yes, just that. If you're happy with that, I have no problem. But if you are not happy with that, we do have something in place to stop that. No worries.
My future is very scary. Now, I just want to ask you if you can help me understand our marking criteria for group 20. So, the mark that we got is, would it be 5 out of 10, 2 out of 10, 1 out of 10, or is it just...
That's the grade. Out of 100. That's a grade. That's a grade. Right.
Okay. So we would have got 10 for that, 10 for that, and 10 for that? So that would have been 30 out of 100.
But each category got its own weighting in the overall grade.
Either way, we did really badly on this, essentially.
You didn't really have a model at all, just the original KGW spreadsheet, and you didn't forecast at all, and it incorporates nothing about the drivers of the business at all.
I told them they didn't listen to me because I essentially did the whole thing. Sent it back to the other group members and they changed it, which is why I had to remove all the explanatory notes because it was what I had done. Now, if I had just submitted the original thing which I had done, they would have not let it go. So, I just want to understand that, but now that you've told me, I should be fine.
You see, these are the things I was looking for.
Oh, definitely, and I literally, I went off the
the
marking criteria.
List. of things.
It's just so unfortunate. So anyway, right now it sits as of 8 out of 100.
Yes. Anyway, are you okay with the new group? Like,
I wanted to ask you, have they all sent
Yeah.
all
Yeah.
5 of them?
Yeah.
Okay.
No, 4 of them.
4.
I need to still wait for the last one. Hong Wei.
He's not responding on the group as well. Like, he responded the very first day. He said, oh yeah, Isha can come in, but then I don't know if he sent you the email address, and everyone is like, oh, we need to respond. but-
Everyone else has sent me email.
Okay.
Do you have still that original email that's sent from Hong Wei? You can forward that to me as
Okay,
proof
it's on my
that
phone.
everyone. Yeah, just forward that to
Okay.
me. I'll officially change your group to 36.
36, yes.
36.
You actually remember that, thank you. No, it's just I've had really, really bad luck. I mean, my first group, I would not have stayed.
I do feel sorry for the students who are stuck with the group issues. This course is actually supposed to be a very rewarding experience.
Definitely, and which is why I enrolled in it, because these are electives for my degree, and I said yes, I want to, because it was so interesting and so fascinating. And when I did, what was the first course? FinM 1001, Foundations of Finance. We talked a little bit about this. He said, oh, in year 3 you'll be like valuing a company, and I thought that's so cool and so relevant. And after that, it just shattered my confidence, which is why I don't feel like doing this by myself and having the 50% moved. It just shattered my confidence, which is why I can't think of doing this by myself now. Like, it's too late into the thing. But anyway, so 20% of this would be accounted for in my final score.
I have to have you do something about the assignment.
Yes.
It's a very important part of the overall course.
Definitely.
Initially, in 2011 and 12,
Yeah.
this course was 100% assignment based.
Oh.
Yeah.
But anyway, I've
Just
still
that
got-
I see a lot of people will just be the free riders. So I guess have
That's
some
not how-
exam-based assessment.
No, that's very good, but at least now I have, if not, I still have 50% in my hand. So I can still, I feel confident enough in myself.
A few weeks to catch up.
Definitely, because like my quizzes and all, I'm pretty comfortable with like the structure. And the final exam will be pretty much like how the quizzes were, like a mix of calculations and
More complicated than that.
more complicated, but pretty much like the similar structure will be given the info,
The
news,
company,
whatever. Okay.
the financial statement, and do the calculations.
And we are allowed a cheat sheet because it said that in
Yeah.
the course outline, but you said you wait until week 12 to give us more information.
The past exam questions have already been onboarded.
Oh, okay, yes, thank you.
In the exam folder, I think if you have a look, these are very important indications what you're going to do.
Oh, definitely, I have to focus on this because 20% is just gone. And yeah, I have to I was aiming for a distinction in this course and I still can get it. I mean, it's still possible. I just gotta rely more on myself now and less on other people. Anyway, thank you so much for all your time. Thank you.
I think I just received his email.
Oh, yes.
Yeah, that's fine.
Awesome.
I got everything I need.
Thank you. Because we had already started on it, like we already split up the parts and stuff, because I said what was doing officially to get the emails, and I didn't want to leave anything to the end, so.
At this such late stage, it's really difficult to get everyone.
More stressful than difficult. And we do have a workshop on Wednesday as usual?
Yes, yes.
Sorry, was there a lecture last week?
On Thursday.
Thursday.
Just the workshop, right? Oh, that's, oh, okay, no, that's,
In the biology place, that's rescheduled lecture.
and then the weekend one was just done in the workshop.
The lecture content's now a little bit messed up. I discussed last week, Wednesday, I first discussed the feedback on the assignment and the first part of lecture 8. Then on Thursday lecture, in the first hour, I discussed the second half of lecture 8 and the second hour on lecture 9.
So this quiz 4 now will cover
Only 7 and 8.
Only 7.
Yeah, multiple analysis, the quiz 4. Yeah.